tested return standpoint, one of the weakest models, if not the weakest models we have, are on inverse treasuries. On funds that make money when treasury bonds go down in value. Well, why is that? Well, because in the past 10 years, treasuries have pretty much gone up in a straight line. Why do I still want my models for inverse treasuries, even though the returns haven't been that great? Well, because what's going to happen over the next 10 years, if interest rates go up, treasuries are going to get killed, and my models are going to do really well. That's why I want to still have those models in there.
Attribution persistency. What that mean?
So once you know where the returns came from, the next question is, why will they or won't they persist? So in our tech stock
wait, actually, you're talking, I think the proper word would be, what is the likelihood of? Because nobody can predict that, but just I know that's a given for you. What's the likelihood?
What's the likelihood
what we
that
saw
they'll
persisting
or they won't?
Persisting or not? Yes.
Right.
All right.
So in the tech stock example, again, understanding how markets work and understanding reversion to the mean, if you're looking at a tech fund that's had 5 years of up 50% a year, it is highly unlikely those returns are going to persist. What's more likely is at some point that's going to get its ass kicked. And that's probably going to be right after you buy it. The Good Harbor example, you knew that methodology doesn't work well in a choppy market. We haven't had a choppy market in like a 10-year period, which means what? At some point, we're going to have a choppy market, and you're not going to be able to generate those returns.
All right, now I'm going to throw out a very unique sidetracking challenge to all of you here, and I don't want to talk a lot about it. We may be at the tail end of everything, but we're not going to now. But take a look at these methodologies in terms of one of the most important elements of your life, which are your relationships, because I firmly believe the quality of your life is really based on the quality of your relationships. And this is, for those of you who are looking to pick a spouse or help one of your kids or something like that. Now, from the little bit I understand about this new phenomenon called Tinder, I don't think this would apply to that, but in terms of something really deep and meaningful, this forward-looking due diligence is we've been asked to do a TED Talk on this, on how to look down the road, and this, now where nobody can predict anything, this puts you in a place, especially if you lock in no sunk cost mentality and agility with all this, it puts you you're in a much better place of control for your future with these kind of mentalities and methodologies going on. So we got return attribution. Why did we get what we got or didn't get what we didn't get or something like that? Attribution persistency. What is the likelihood of the continuation or not continuing? All right, tail risk analysis. What is that, Matt?
In simple terms, that's what can go horribly wrong. And that's an extremely important question. Great example is LJM. So you're looking at LJM, how they're getting their returns. It's possible those returns could persist. I mean, I can keep writing options every single month on stock indices and pocket the premium month after month. What can go horribly wrong, though, is I can go to zero. And I can go to zero, like, really, really quickly. So, from you start going through the backward-looking due diligence process on an LJM, and you kind of stop at I could go to zero. Or, same deal with all those people buying the inverse volatility, the XIV fund, that at the same time LJM went to zero, also went to zero. Same deal, getting great returns. They could persist because volatility can keep going down, but you could also go to zero.
Well, and
Or
same back on long-term capital and some other Nobel laureates that basically screwed the pooch. That's where
well, and
the
on a long-term
unwillingness
capital
to look.
management, well, a long-term capital management would fail at the, how can these persist? You're not going to generate 40% a year every single year doing arbitrage. At some point, the Wall Street trading desks who are doing your trades are going to figure out what you're doing, and you're going to get crowded out.
All right. So, but the tail risk would come into at those black swan events, what should never happen, but winds up happening.
Right, over and over and
Basically,
over again.
All right. Portfolio flexibility. This is a biggie with us, and this deals, before Matt goes into this, in the personality of the manager themselves. Okay? This is where we're looking past the strategy into the person. All right? Do they have the ability to jump past their own ego? And so, Matt, talk a little bit about that. Let's talk about, because you're a poster boy of passing that test. And
Right.
what you always talk about, you're not afraid of change. You're afraid of what?
Not changing.
I mean, where most people really have either a fear and or an uncomfortable aspect about, because it's exhausting. God, I just did all this work. Now I got to change again. But Matt comes into every day with the opposite fear. And now, yes, so just an extreme example of what we look for in flexibility. But what else can you talk about this? Okay, what changes in the strategy, if any, would a manager be willing to make? Is what our definition is. Can you want to elaborate on that, Matt?
There's. I mean, you're not making change for change's sake. It's what changes will you make when, and it's not an if, when your methodology cycles out of favor. And so it's being able to look at, what's going on and being able to ask yourself, all right, is what I'm seeing, just a simple anomaly that's going to go away that I don't have to worry about? Or is what I'm seeing either A, going to be more prevalent, in which case I probably do need to worry about it, or even worse, it's the new normal, in which case I definitely need to worry about it, instead of putting your head in the sand and saying our methodologies always work, this is just an anomaly, it'll go away and everything will get better, don't worry about it.
And it's also another element we look for is what happens when the managers are getting their 15 minutes of fame. What happens when what they put together is killing it, and how are they acting, reacting, responding to that? And again, these are things that Tuttle not only passed with flying colors, because I'm speaking about him in particular because he's the one here I'm interviewing, but also this is where trend aggregation came from. Going back to, what was it, 2015 or 16, or I can't remember what or when, but
no,
I know
August 2011.
Oh, all right. Well, that's why when you guys got to call me when I say we, because obviously. So way back then, all right, something I know started to change. And you took the aspect, a couple different things. One, I know was that one of those times you were like the darling of Wall Street. There's been more than one time that Matt's been every newswire service and major media company and Wall Street Journal is just down his throat because he's killing everybody. And I've seen more than one time when he's given interviews about it, but at the same time tearing his stuff to shreds behind the scenes to redo it at the same time when he's getting all his accolades for his stuff. But also, so you can give you can give a particular example there, Matt, because it's a really good real life example of portfolio flexibility. And also, I know when the market started changing and and that didn't fare too well for you, and you said, well, what if that, and there was nothing that showed that that was going to be a permanent change, but you decided to make some permanent changes with your portfolios, with your strategies, because you said, what if this is going to be the new norm? So let's talk about both those things. Let's talk about that one thing that took you out of rebalancing monthly.
Yeah. So August 2011. I don't know if you guys remember that month, but it was the month the wheels almost fell off the world. I think at the end of the month, the ECB and the Fed came out and did something, and if they hadn't done it, we would have been in 2008 all over again. It was ugly. Every day you'd wake up, the Dow was down like 400 points pre-market. August 2nd, 2011, we got out of stocks entirely, and we got into treasuries and tips. So we made money over August, got interviewed in some Dow Jones Newswire stuff and some other publications. And, I was a hero for, avoiding that big loss. But I sat and I looked at it. There are some other managers who were competitors of mine at the time. And I was looking and saying, all right, they didn't get out and we did. And so I started kind of doing an analysis. All right, why didn't they get out? Why did I get out? And if things had happened differently, if the return stream had happened differently, so and we were moving on a monthly basis, and August 2nd was, nothing special about August 2nd. That was the day we rebalanced the portfolios. And, if August 1st had happened differently, if July 31st had been different, if August 3rd, I started doing these calculations and realized, if things had come up differently, we may not have gotten out. And that's what started the idea of trend aggregation, where I realized, all right, there's nothing inherently wrong with rebalancing on a monthly basis, but I've got to have some other stuff. Because what if everything went wrong and my entire portfolio was locked in for the entire month? I need some other things that maybe rebalance weekly or maybe rebalance daily, where we can move much more on a dime. And that's kind of what started this along. I think your next example, talking about, the choppy market of 2014, 2015, caused,
by the way, killed many normal, good tactical managers, but didn't kill you. All right, it did it first. I mean, killing to Matt would be like you'd be like, "What are you worried about? You just went down this little bit here," but what he hates anyone. He's like weirdly obsessive compulsive about losing anything, but that wasn't why you changed. You saw the choppiness and you said, well, what if this becomes the new normal? If it is, we're screwed. So let's talk about that, Matt.
Right. So
this is all really good example on portfolio flexibility.
So I looked at it from three standpoints. Is this just an anomaly? And I figured, you know what, it probably isn't. It's probably a structural change in markets where we're going to see choppier markets going forward. Then I said, so it's probably either the new normal or it's just going to be more prevalent. So then we looked at it from the standpoint of, okay, well, let's say it's the new normal or more prevalent. How can we improve what we're doing so that if those are the case, we won't care at all without shooting myself in the foot if it turns out I was wrong and this was just an anomaly and we went back to straight up and down market. So we needed to make sure we were implementing changes that would do fine in a choppy market, but would also do fine if the market just reverted to going straight up or straight down. And that's what got us into intraday timeframes. And it was really the impetus of these choppy markets getting us to wrap our head around, well, wait a second, why are, it's the same thing. Well, what's so special about a month, which got me to doing, weekly and daily. And then it's like, well, what's so special about a week or a day? A 30-minute bar looks the exact same as a daily bar does. Why not move on an even quicker time frame than we were doing before? And, that took us to an entirely new level.
Okay, now remembering when you get into, we'll get into deeper into this week about intraday trading, things of that nature. But this is not day trading where it's market timing, where you're using technical aspects to try to stay ahead of it. Yeah, tactical done right is responding in real time to what the only thing that is right is. It's not your methodology, but the market itself. And so what you've constructed for trend aggregation is down to a microcosm of that, of responding in real time on multiple bases a day based on what the market's saying to do. Comments on that, Matt?
Well, I mean, that's exactly it. I mean, we can really, really, really move on a dime. And, unlike someone who's moving on a daily, weekly, or monthly basis, you don't have to wait. If the market, so it's not predicting, but if the market starts to move intraday, then we can move with it one way or the other.
What about the Schwab and the Betterments and all these online computer programs, Matt? Is that relevant to this discussion? Because we're talking about really fast-moving changes in allocations.
No, that's not relevant. I'm assuming you're talking about the robo-advisors.
Yes.
That's not relevant. I don't think that's going to have a structural change in the market. I mean, things that are, high frequency traders, all the quantitative guys out there. All that stuff has structurally changed markets. But from a trading standpoint, the robo-advisors haven't. I battle the flash traders from time to time, but and those guys are a pain in the ass. But no, the robo-advisors that really doesn't have any impact.
Matt, this is Corey. I have a question, Ron. This is Corey Mizell in Houston. Just thinking about everything you've been saying today, we've been talking a lot about just agility has been kind of the underlying theme. Would you say that what you've done in the past and what you're doing going forward, that your agility is more predicated in survival, or is there some sort of cost benefit you're doing when you're considering making these changes and evaluating these different methodologies?
So,
good question. Go ahead, Matt. It's pretty personal, but yeah.
Well, no, the agility comes from understanding that things can change in an instant in this market. And the old kind of way of doing things, like I said, used to be if something happened on August 3rd, we'd have to wait until August 31st to react to it. In this day and age, that just makes no sense. Something can happen at 9:30 and we're reacting to it in real time. And let's say it was nothing and it was a head fake. Well, we can always go back to doing what we were doing. So it's not that big a deal. So you don't have to worry, all right, so the Fed comes out and does something, but, then they walk it back, fine. So, we sell and then we buy right back. We're able to have that. I think that is what you need in this marketplace in this day and time. You need to be able to move on a dime. You need that agility. And, and we're constantly working on the models on a really a minute by minute basis, and I'm not sure if this is answering your question or not, but on a minute by minute basis, we're watching, all right, what's the market doing? How are our models reacting to what the market's doing? What should our models be? How would I think our models should be reacting? is there anything we're seeing that, that looks different? Are models getting in that I wouldn't expect to get in? Are models getting out that I wouldn't expect to get out? Are we 75% invested when I would think, given everything that's going on, maybe I'd expect this to be at 60? Or, are we right around where I'd expect this to be given what's going on? What are we seeing that's abnormal? Is that probably just a fluke? Again, is it the new normal? Is it, possibly more prevalent? How can we do better in this type of market environment? How can I develop a better model for this stock? How do we come up with a better basket? So, we just made a massive change over the weekend to how we pick our baskets that kind of came from asking these questions. How can we come up with a better basket of stocks? And, and kind of constant testing and going through ideas and kicking things around. And, and a lot of that is going down dead ends, but more often than not, you come up with something that's better than what you have, and you go ahead and you implement that and you keep improving.
And before we get too deep down this, hang on, before we get too deep down this, tomorrow we go into model building, pattern recognition, things of that nature. We can go a lot deeper then. I just want you all to take away the one theme from point 4, portfolio flexibility is, is that having a sense of fast and urgent and balanced urgency with speed and agility. How can you not this day and age? Those of you who say to yourself, and in each one of you you're going to have to go into your own world for this to be truthful, is, well, now I'm fine with what I'm doing. It's always worked for me. You are in a dangerous land because you are in an old land. It might have proven itself to work for you over time, but this day and age moves so much faster than ever before, and it's not going to slow down. So just, kind of buyer beware if you're buying your own rhetoric there. All right.
Hey, Ron.
Yeah.
Ron, one question. It seems to me on forward due diligence, and this is the same as business succession, the key is what happens when Matt dies tomorrow in an accident? How much do you get into this is that there's an individual, is there a core team, is there a backup? How do I know?
That is a wholesaling question. Now you're getting into a company or a product, and I will tell you what Matt's answer is. If he dies, he'll be like, well, I don't care, I'm dead. It's your problem. Of course he has things that succeed, but we're not dealing with that right here. We're dealing with concepts here, Bill, not his company or products. We're dealing with the pure conceptual aspect, and how the real key thing is not in succession planning or anything like that. I totally disagree on that. This is just like, what are you doing now? You're dead, dude. Okay? Succession plan's a whole different thing. So no, that doesn't have anything to do with this. What we're talking about is forward-looking due diligence for a reverse engineering aspect versus looking at just past track records. And I want to go into 4 other points here too. Go ahead.
Yeah, it's true. When we talked about this before, and we're discussing extreme portfolio flexibility, and not only with algorithms and high-frequency traders and robos, but when we go 24/7 in the stock market, if you don't have extreme flexibility in your models and how you're looking at your portfolios, you want to comment on that? Because we've talked about that to some length.
Yeah.
Well, we are going to hit that. We are going to hit that tomorrow, Drew. And there is a section tomorrow of understanding current market action. Because yes, the market is changing in ways that Drew's pretty much aware of, but not too many people understand like how fast and how crazy all these changes are. And so, yeah, I'd love you to comment on it, Matt, but tomorrow.
Okay.
It's going to take us off track here. Sorry, Drew, for that.
All right.
All right, let's continue on this forward-looking due diligence page. Now, it says due diligence of aggregated portfolios. This kind of starts bleeding into this adaptive optimizer concept. Or going back to somewhat on the peripheral of your question, Guy Porter, Well, what about when you're putting these different managers together? All right. So keep in mind, we're still looking at ways that go against the grain of standard due diligence.